Hi, good afternoon. My name is Lanre Bulura from Chapel Hill, Denham. I'd like to thank you for joining us and taking time out of your busy schedule. While there is a lockdown in Lagos and a flight to digital, a lot of people are working remotely. And we've been quite impressed talking to a lot of our clients to see that the level of work has not changed. People are actually working more harder, leveraging on the technology infrastructure that they have. Um, Again, we do appreciate your time in this period. We're all aware of what's going on in globally. Nigeria is not immune from what's going on. The coronavirus has been quite devastating. It's had an impact on the day-to-day lives of millions of people and the overall global economy. And we felt we should engage our clients, and our clients are very varied, from buy-side investors to corporates, looking for answers to the uncertainty that we are in the middle of now. We had an outlook we published early this year. It was quite promising, while we were somewhat cautious. We actually had a somewhat positive outlook with the coronavirus. I mean, it's definitely a big change from what we expected, the economy, or how the economy is expected to perform. So we felt we put this together and take questions, and you'll only be in listen mode. At the end of the presentation, you'll be able to type in your questions, and we'll answer them to the best of our ability. The presentation, or should I say the webinar, will be led by Taj. Taj Ibrahim is the head of our research, and he will be supported by Omotola, who is our in-house economist and strategist. And also by Aderonke Akinshola, who is the head of financial services. And without further ado, I'll have Taj. Please, I can start the presentation. Thank you.
Okay, so thank you, everyone. Thank you, Lanre. And good afternoon, everyone, for joining us on this webinar. As we know that the situation around coronavirus is as indicated on your screen, where as at last night, Nigeria had a total of 407 confirmed cases, with interestingly 128 have been discharged. Sadly, we have 8 deaths. This is coming from the NCDC. So Nigeria is affected, as we all know, and probably all the states are probably affected as we speak. We'll talk more to this in the next couple of slides. But let's take a look at the global environment. The global environment, the expectation is that in 2020, there will be a recession, which should probably be the worst recession since the Great Depression, in 1990. So economy is expected to contract by about 3%, and the worst hit, most likely, based on IMF's numbers, is going to be Euro area, which is expected to contract by about 7.5%, and the sub-Saharan African region, where Nigeria belongs, is expected to contract, by 1.6%. And so another one point to note here is that the moment we have all this sort of recession in 2020, 2021 most likely will be a recovery year for the global economy. If we take a look at what has happened in China, where the pandemic was, where the outbreak started from, so we see that they have somewhat returned to recovery mode, as indicated in the Chinese PMI, that indicated that there was a bit of recovery in March. And that was after COVID-19 curve began to flatten in the country, and then they lifted some movement in restrictions. So we expect that by the time we begin to see this kind of development globally, where number one, cases began to flatten. Number two, some restrictions are being lifted. Then we begin to see some sort of global economic recovery in that regard. If you take a look at the responses from the global authorities in terms of both fiscal and monetary authorities, we see that the US led the pack in responding to the development by aggressively cutting interest rates. So mostly all the countries in developed markets cut interest rates, with the exception of like the Eurozone, where rates have been sort of left unchanged, and also probably Japan, where we've had rates unchanged. But if you take a look at emerging markets, all of them absolutely, mostly speaking, have cut interest rates. And in Africa, with the exception of Nigeria, we've had Kenya, Ghana, Egypt, cut their interest rates, just so that they support the economy and reduce the impact of the coronavirus on economic activity. If you take a look at the fiscal side of the authority as well, we have seen some sort of responses from the U.S. government, for example, where they are looking for, where they've put in approval for about $2 trillion stimulus plan. At the same time, we are seeing, development also in the Eurozone region, pointing to, about 500 billion euros as rescue package to limit the impact of COVID-19 on the economy. So we begin to see some of these, sort of, stimulus being announced around countries. By the time the effects begin to feed into, the entire economy as a whole, chances are that the impact of coronavirus on the entire, global economy is somewhat reduced. If you go to the major commodity that everybody seems to be talking about now, it is the crude oil, that everybody seems to be focusing on now, where mostly the exporting countries have largely been hit by, lower crude oil prices. For us at Chapel Hill Denham, our base case expectation for crude oil price for 2020 has been lowered from somewhere over $60 per barrel to about $40 per barrel on average, and that we are looking at our base case scenario. And for our bull case scenario is for a $44 per barrel price on average, and as a bear case, we see $36 dollars per barrel. What we believe will probably be supportive of our expectation is the OPEC plus agreement to lower production by about 10 million barrels per day in the month of May and June, and also by further 7.7 million barrels per day in the month of July to December. And also we expect the G20 countries to also lower production by about 3.7 million barrels per day, which will mostly take the form of well declines and slowdown in drilling activity. So on the back of all these factors, we think that chances are that in the second half of this year, crude oil prices will trade in such a way that, 2020, we can average about, $40 per barrel in 2020. And then maybe beyond 2020, we can begin to talk about other numbers. But as we speak, the OPEC agreement, as well as, the G20 countries, I think, are key to our expectations around crude oil prices. I pass it to my colleague, Aderonka Akinshola, to run us through, updates on the COVID-19 pandemic.
Thank you very much, Taj, and good afternoon, everyone. So very quickly, I will just run us through the COVID-19 situation in Nigeria and just to look at where we are now and in terms of the actions and policy measures that have been taken by the different authorities. So starting with the COVID-19 situation in Nigeria, as of yesterday, the NCDC reported that we have 407 cases, with about 267 being active cases in Nigeria. If you look at the first chart on this slide where the lockdown is highlighted, we will see that this steep increase in the number of confirmed cases basically started when the lockdown commenced. And the aim of the lockdown is to ensure that on one hand, for the health officials, they are able to actively contact trace those who possibly have coronavirus, and also to ensure that they are able to test more people for coronavirus in Nigeria. And on the part of individuals is to ensure that people are effectively practicing social distancing to ensure that people who possibly have the virus do not further spread the disease. In terms of spread of the virus across the country, we would see that at the moment we have the virus being active in 20 states, including the FCT, out of the 36 states that we have in the country, plus the FCT. But Lagos is still the epicenter of the coronavirus disease in Nigeria. Following closely is the FCT and Osun states. But we have seen increasing number of recoveries of coronavirus cases in Nigeria as well. As of yesterday, we had 128 recoveries, and I think this sort of gives hope to Nigerians that, you know, if you do contact this virus, the health officials are doing as much as possible to ensure that people recover from these cases, and also to lower the number of deaths, even though at the moment we have 12 deaths for coronavirus in Nigeria. And in terms of the number of tests that have been carried out, because this is a key concern, a quick key question that a lot of Nigerians are asking right now: are they testing enough? If we look at the charts, we'd see that Nigeria is not testing enough because we are just testing 24 people per 1 million population, compared to our fellow African peers that have 1,400 for South Africa, and for Egypt 246. Even Ghana is testing about 1,600 people per 1 million population. However, the health authorities are also reacting to this to try and build the testing capacity within the country. So yesterday, the NCDC reported that they had increase the number of testing labs from 6 to 13 over the course of 3 weeks. So we expect that this would ensure that more tests are being carried out to identify possible cases of coronavirus in Nigeria. And just to look at how we expect that the curve would eventually flatten. If you look at what has happened in other countries, such as China, a lot of the European countries have been badly hit by this pandemic, would see that within a period of 3 to 5 weeks, when lockdown is being implemented, there starts to be a peak in the number of cases before the curve starts to flatten. We are in our 3rd week of lockdown, so our expectation would be that by the end of the month, we should start to see the curve flatten in Nigeria. So moving on now to what the authorities have done in terms of relief packages and palliative measures to try and curb the impact of the coronavirus on the economy. Starting off with the Ministry of Finance, I think the key ones here would be the establishment of the 500 billion naira COVID-19 intervention fund. The second one being that the Ministry of Finance has approached the IMF, the World Bank, and the AFDB to raise up to $6.9 billion to try and support the economy during this difficult times. And then the third one being the amendment to the 2020 budget, which we'll speak more on later on, that the government has also implemented. From the presidency, during the lockdown speech, President Buhari communicated having moratorium for empowerment programs as well as federal government funded loans, and he also spoke about having food rationing as well as cash transfers to vulnerable Nigerians. On the part of the National Assembly, the key ones would be the tax rebates of 50% that is being considered to be given to companies that do not retrench staff during this period, and then the other one being the suspension of duties on medical necessities that are needed to be able to curb this crisis. And for the CBN, which is the major one here, the total relief packages for the CBN is about 2.65 trillion naira. And the key one that was initially implemented was the moratorium given to CBN intervention loans and the reduction of interest rates on these loans by about 400 basis points. But the CBN has also introduced other measures such as 1 trillion naira manufacturing loans, as well as 1.5 trillion naira infrastructure projects. So in total, all of these relief packages by the different authorities in Nigeria is estimated at about 4.5 trillion naira, or 3% of the GDP. And this again is to reduce the impact of coronavirus disease on Nigerians, on businesses, as well as the economy as a whole. So now I will let Omotola run us through our macroeconomic expectations given the current realities.
Thank you very much, Ronke, and good afternoon, everyone. So in the next couple of slides, I'll be taking us through our forecast changes for the economy for 2020, starting with our GDP growth expectation. Despite the stimulus measures that Ronke earlier discussed, we have lowered our base case outlook for GDP growth to a recession, which could be as worse as minus 2 to 3% contraction, or as low as our current base case forecast of minus 0.1% contraction. And our revised outlook for the economic growth is based on 4 factors, which I will discuss now. The first thing to note is that the current challenge we are witnessing is first and foremost a supply side crisis, not just a demand problem that can be cured by stimulus measures. So stimulus can do little to prevent a contraction in the initial phase where we are implementing lockdowns. But once we see the curve begins to flatten and we see the lockdowns being exited from, then we should begin to see a recovery in the economy, which will be aided by the stimulus package of the government. But for now, we think a contraction in activity is unavoidable. The second thing to note is that the public sector in Nigeria is very, very small. Government spending accounts for less than 6% of GDP. So with the 4.5% stimulus, 4.5 trillion naira stimulus package, it cannot really go far enough to prevent a slowdown in an economy of over 145 trillion naira of output annually. The third thing to note is that the states under complete lockdown at the moment, that is Lagos State, the FCT, and then Ogun State, they account for a disproportionate share of economic activity in Nigeria. By our estimate, the 3 states account for about 75% of VAT collection. VAT is a consumption tax. So if you are seeing 75% of VAT coming from these 3 states, then it more or less shows that they account for a disproportionate share of consumption in Nigeria. And then these 3 states, in terms of supply side economic data as well, they account for roughly 50% of economic output annually. So with the 3 states under complete lockdown, we think it will have an impact on economic growth in the end. The fourth factor is our oil sector expectation. So we all know, like Taj mentioned, that OPEC Plus agreed on a production cut agreement over the weekend, while Nigeria's output is being contained at about 1.4 million barrels per day over the next 2 months. We think everybody is going to cheat eventually. So Nigeria's crude oil production, if we include condensate, we think it should average 1.87 million barrels per day, which is lower than 2.01 million barrels per day that we produced last year. So on that basis, we should see a contraction in the oil sector GDP as well. So a combination of contraction in the oil sector and then a slowdown in the non-oil sector should lead to a recession in 2020. And then to the next slide, where we are essentially discussing how the lockdown will affect various sectors of the economy. For the agricultural sector, agricultural activity is mainly concentrated in the rural areas and might not be directly impacted by the lockdown, but it will be indirectly affected because of the issues regarding transport and the other supply side challenges. So we're expecting a material slowdown in agricultural sector growth. Secondly, for the industrial sector, which consists of oil and gas, manufacturing and construction, like I mentioned initially, our expectation is that the oil and gas sector will enter into a recession, manufacturing the same thing, and construction. For the services sector, we're a bit more nuanced on this because we think there are some policy-driven initiatives that can support the sector, particularly in the finance and public admin subsectors. The finance sector was one of the highest performers that we had in Q4 2019 when we saw the impact of the CBN's policy on loan-to-deposit ratio, resulting in a very strong loan growth and in the end contributing to over 20% expansion in the finance sector. So we expect the same thing to happen in the first 3 quarters of 2020 because of the low base effects. And then in the public admin sector, in January, we began seeing the implementation of the new minimum wage, and public admin GDP is essentially estimated using the wages being paid to public sector workers. In 2011, we had the last minimum wage increase, the sector grew by about 15%. I would think it's similar this time around. So we expect to see expansion by public and telecom sector, impact in the other subsectors in the services sector. So moving on to the next slide, where we talk about our inflation outlook for the year. So essentially, last year, we saw a pattern emerge in the second half of the year, where we saw consistent increase in inflation rate as a result of the border closure, which affected the prices of food items. And at the beginning of this year, I think we saw some positive surprise, particularly in February, when after we saw the VAT, the new VAT rate, when we saw it kick off, we saw only a very mild increase in inflation rates. And two key things happened in March that could affect our inflation outlook. The first thing is that we saw a decline. We saw a policy-driven reduction in the prices of PMS in Nigeria to 125 naira initially. It is now down, below 124 naira from 145 naira. That's very positive for inflation. And the second thing is that the NARC, they have delayed the planned increase in power tariff, which is also positive for near-term inflation. But despite that, we still expect to see further uptrend in inflation rates in the near term, driven by I would say two major things. The first one is that because of the impact of COVID-19 on the global supply chain, we are going to see scarcity of some mainly core items, which we think will contribute to uptrend in inflation rates. We also expect to see further depreciation of the exchange rates, which will lead to some pass-through impacts on both imported food inflation and then core prices. So our base case view is that we should see inflation rates approaching 13.5% by year end. But this particular inflation rate forecast, we think we might still have to actually withdraw it and change it in the end, because we understand that the MBS is planning to revise and rebase Nigeria's consumer price index later this year. And the outcome of that rebasing exercise will have a material impact on our inflation outlook. Nigeria's consumer price index was last rebased in 2010, when the base year was changed to November 2009 from May 2003. And we saw that after the rebasing, the inflation rate was revised higher to 13% in July 2010, the first month of implementation, from 10.3% in June. We saw a rebasing happen in Ghana last year as well, where we saw a more than 1 percentage point decline in inflation rate as a result of that rebasing. So rebasing can lead to two outcomes. It will either show that you were initially underestimating your inflation rate, or you are overestimating it. In our own case, we think we are likely overestimating our current inflation, and I'll give you two reasons for that. The first one, Nigeria currently has one of the highest food ratings in the CPI. If you compare all the other African countries, South Africa, for instance, food constitutes about less than 20% to its consumer price index. In the Francophone West African region, it constitutes less than 43% to their CPI. Nigeria currently is 51.8%, and it was reduced materially when we had the last rebasing from 64.4%. So we think there's a very good chance that we might see a downward revision in the contribution of the food index to our composite index when the rebasing exercise is eventually concluded. And secondly, the ICT sector takes only a very, very minor share of our current CPI at 0.1%. But we have to understand that our current CPI is based on a consumer survey that was conducted more than 2 decades ago, 2003, 2004, when we never had a developed communications industry. So there's a very good chance that we're going to see an upward revision in the contribution of communication sector to the CPI. So by and large, we think that eventually, when we see a subtle moderation in the contribution of food and an uptick in the contribution of communications in the weighting of the CPI, you see inflation rates probably being around the long run trend of 12% when we have the final figures being released. And now we then move on to our external sector expectation for the year. One key thing we have to take note from this slide is that Nigeria is entering into the current oil price crash with a materially weaker external sector balance. So when we had the last oil price crash in 2014, the year before that, Nigeria had a current account surplus of over $20 billion, or more than 4% of GDP. This time around last year, we had a current account deficit of $17 billion or 3.6% of GDP. And our expectation is that the current decline in oil prices will lead to a 43% contraction. Decline in both oil prices and production rather will lead to a 43% contraction in Nigeria's exports to the lowest level, since 2016. And that will lead to a much more weaker current account balance. But having a current account balance is not a crime. I mean, we have many African countries that have naturally operated very large current account deficits. But the problem is that, unlike some of these countries, Nigeria has very low level of foreign direct investments required to fund this current account deficit. Last year, our FDI was very, very minimal at about $3.3 billion or 0.7% of GDP. So it cannot fund the deficits that we are forecasting in the current accounts. Secondly, our external reserves is a lot more leveraged than we used to have because the CBN has become a lot more reliant on swaps and HOMOs to build its external reserves. Before 2015, close to 90% of the FX earnings to the CBN used to come from oil exports. But now, after the oil price crash in 2014, the CBN started to use foreign offshore investment in automobiles and swap position to build external reserves to the extent that over 70% of the FX that comes to the CBN now is related to the non-oil sources. And we all know that at the moment, because of the risk aversion for EM and FM assets, we are seeing very little flows coming from external investors. And this leads me to the next slide, where we are looking at external positioning in our capital markets. And by our estimate, we have very weak positioning in equities and bonds, but non-resident positioning in OMO is very, very large, at estimated $14.6 billion in December 2019. So if we net off the contribution of swap and OMOs from our current external reserves, the organic portion we estimate at about $16 billion. And if we want to take a much more conservative way of looking at the external reserves, in December last year, CBN did a transaction where they revalued their gold reserves to reflect the current prices of gold. So they had that gold reserve, they built it up in the 1970s and 80s when prices were very, very low. And after that exercise, they booked a mark-to-market gain of $1 billion. So if you even want to net off that particular component from external reserves, we think the organic portion of the reserves is currently below $15 billion. And this takes us to the next slide, looking at the liquidity in the FX market at the moment. We have seen liquidity collapse since late March when the CBN stopped selling dollars into the high and yield window. Currently, the market is trading about $59 million on average. Before COVID, it was trading as high as $400 million on some days. And because of that, we have seen high and yield window rates trading as high as 401. Our view is that one of the reasons the CBN has stopped intervening in the FX market is because of the current lockdown, right? So they have stopped selling both to BDCs and also in the high and yield window. And we expect that after we begin to see a staggered exit from the lockdown, probably by May, then the CBN will probably return to the high and yield window to start selling dollars. But the question is, can the CBN actually be able to ensure supply at the current exchange rate over the short to medium term? We think the answer is no, because if you look at the slide we have there, last year the CBN sold about $38 billion, to different segments of the FX market. The BDCs got about $14 billion as well. And that level is, the $30 billion is higher than the current level of external reserves. And we're even anticipating inflows to the reserves to drop because of the decline in oil prices. And this is going to the next slide where we are making our projection for the exchange rates. Our view is that the initial adjustment done by the CBN is not enough to actually rebalance our current accounts. And we are taking this position based on a historical trend as well. If you look at 2008, when we had the first major export crash in the last 2 decades, exports declined by 34% due to the global financial crisis and the impact on oil prices. And we saw a 22% devaluation. 2014 to 2017, when exports fell 58%, we saw a 56% devaluation. This time around, exports is forecast to decline by 43% in 2020. So we think our base case view is that this year will probably need to adjust the currency further to ensure that the current account is sustainably, rebalanced. And I'll move on now to our fiscal policy outlook. So Our fiscal policy outlook, I mean, we saw the federal government, the Minister of Finance, earlier last week, coming out to give us our revised 2020 budget expectation, where they have essentially slashed revenue estimates by 43% to 4.5 trillion naira, and expenditure was little changed. It was trimmed only by 3%, and that is expected because 80% of our expenditure for the year consists of recurrent, non-debt recurrent spending and debt servicing obligations, which you cannot delay. So the combination of a large revenue cut and barely changed expenditure resulted in a higher deficit than initially projected, which I will discuss on the next slide. So on that slide, we are showing the revised budgeting, the revised borrowing plan of the federal government. Initially, the plan was to do about 2 trillion naira in fiscal deficits, of which 840 billion will be raised locally and 850 billion will be raised externally, and the others will be sourced from multilateral partners and transfers from special accounts of the federal government. But this time around, the federal government has now added a new borrowing line, which is termed incremental borrowing, as 2.8 trillion naira, and I will discuss on that, much more later on. But going to the next slide now, which is showing Nigeria's current debt burden, which is, according to the DMO's estimates, very low at 19% of GDP. But we think there are valid reasons to begin to ask questions about debt sustainability, because by our own estimate, the current debt burden is not being accurately reflected by the official figures, and that is why the S&P rating agency is actually estimating Nigeria's public debt at 45% of GDP, because they consolidated the CBN's OMO obligation. We are a bit more optimistic, I would say. So we were estimating the debt burden at around 29 to 30% of GDP. Same thing with the IMF. But I think the key thing that people are actually looking at is the debt service to revenue ratio, which we expect to hit 83% in 2020. But of course, we have seen a new push among multilateral, lending agencies, where they are now discussing about granting moratoriums to developing countries to support them in this period, and particularly for the poorer countries within developing brackets. And I mean, people have been talking about whether Nigeria could benefit from this and the possible impact. So the next slide here just shows us what the possible impacts of this could be. But in our own view, the moratorium on debt service payments by multilateral lenders will have a much more weaker impact on Nigeria because of two reasons. Number one, Nigeria's public debt is largely domestic. External debt is just 33% of the total. And then over 60% of the external debt is owed to multilateral or bilateral lending partners. But when we looked at the amounts we actually paid in servicing these external obligations to the multilateral partners last year, so it's very minimal at 164 billion naira. So if we just assume on an optimistic scenario that all the current multilateral and bilateral debts either hold to the China Exim Bank or the World Bank or the German DFI, we think the amounts we can actually save is less than 200 billion naira, which is very, very small compared to the size of Nigeria's current debt servicing cost of over 2.7 trillion naira. And that leads me to the next slide as well, where we have seen the federal government now discussing with multilateral lenders to actually unlock more borrowings in terms of external loans. And one of the partners that we have approached is the IMF, where we are demanding for $3.4 billion in terms of the rapid financing instruments. But we think that the $7 billion we are currently targeting could probably be a bit very optimistic, because if you look at the list of African countries that have accessed the IMF's emergency funding over the last 2 months, many of them were granted less than 100% of their SDR quota, with the exception of very few countries, such as Ghana, who just came off an IMF program, and IMF is heavily invested in ensuring that the country does not fall apart. So they were granted 100% of their SDR quota for the rapid credit facility. For the facility Nigeria is requesting for, typically the IMF typically grants between 35 to 37.5%, to 75% of your SDR quota. And Nigeria's SDR quota is currently 2.45 billion SDR, which translates to $3.4 billion. So to be very optimistic, we are targeting that Nigeria could probably source about half of what we are targeting at the moment in the short term to finance our widening budget financing gaps. And this leads me to our capital market expectation for 2020. And in the fixed income markets, the key thing we have been noticing is that there seems to be a bit of disconnect in the pricing of local currency yields and foreign currency yields. In the local currency markets, Nigerian local currency bonds are still outperforming EM and FMPS by a very, very wide margin. On a broader range, EM local currency bonds are down between 10 to 14% year to date, but Nigerian bonds are still up slightly year to date, or more or less flat, depending on the index they are tracking. But on the other leg, if you look at the hard currency sovereign bonds, our euro bonds essentially, we have underperformed our EM and FMPS. On average, EM countries' bond spreads have widened about 280 basis points year to date, while Nigerian bonds have widened about 565 basis points year to date. So this disconnect we are seeing implies two things. Either the local currency yields are overvalued, or the foreign currency yields are being undervalued. Our view is that it is a combination of these two things. On the local currency leg, the key driver of the outperformance is the liquidity dynamics to the Nigerian fixed income market. The CBN changed the rule of the game last year when they denied non-bank investors from buying home mobiles, and that will continue to have an impact on the pricing of local currency securities. But there are two things that will actually change this dynamic. The first thing is that the federal government now has a wider budget deficit to fund. And secondly, the Central Bank of Nigeria is looking to actually start off a 15 trillion naira infrastructure fund, of which they'll be looking to partner with local fund managers to, in terms of a takeoff capital, right, for the fund. So that could potentially lead to higher supply of securities over the short term, over the short to medium term, and more or less reduce the imbalance we are seeing between supply and demand. But our view is that this outlook is not very certain because the CBN could as well, actually become more accommodative on its monetary policy, right? At the moment, the CBN is holding over 7 trillion naira in terms of excess bank reserves, right? Which it could actually reduce to support commercial banks to fund all its initiatives. So the outlook for that is not very, very certain. And our recommendations for clients is that you should stay very, very flexible in terms of your bond exposure. Don't take too many active risks. That's our recommendation. Try to match your portfolio duration to the market duration, which is around 3.6, right? So that either way the market swings, whether they come out with a very bullish, with a very conservative outlook for borrowing in the local market, or they are not so conservative, you are best positioned to take advantage of this. I will give more insights on our trading strategy for the external for the euro bonds in the next slide. In the next slide, this just shows our view in terms of whether we think Nigeria is at a risk of default of it. Seeing multiple credit downgrades by rating agencies. S&P downgraded Nigeria in March to B minus, from B, Fitch downgraded to B with a negative outlook from B plus. We also expect, Moody's have not done their downgrade, but our base case view is that there will be another downgrade by Moody's later this year to B3. But despite that, we think there's still an opportunity to actually tap into the foreign currency bond market, because the current pricing is almost as soon as Nigeria is going to default on its bonds. Most of the sovereign bonds and even the corporate bonds are trading with credit spreads above 1,000 basis points, indicating distress level. But we think that for the sovereign foreign currency bonds, Nigeria has very little obligations over the near term, and we think we can still fulfill these obligations. So annually, we spend about $800 million to service our real bond interest payments. And the next maturity we are having is next year, January, $500 million. After that, the next one is 2022, $300 million. And the final one in the near term is 2023, $500 million. After which the next obligation comes in 2025. So when we aggregated the amounts we would need to service both the interest and principal repayments, we think our external reserves and external assets sufficiently cover for all these obligations. And even when we stress our model to actually take into consideration a 43% decline in exports, our exports still cover our external debt at about 1.3 times. So we think the risk of default is very, very minimal. And I mean, there's an opportunity to actually trade the short duration, sovereign hard currency bonds. We started to see, investors actually taking cognizance of this over the last 2 weeks, as we have seen yields actually decline a number of them. And then in the corporate segment, our view is that the banks are best positioned, the Tier 1 banks are best positioned to weather this storm because they have sufficient external assets to service their obligations. All the Tier 1 banks, most of the Tier 1 banks that have outstanding euro bonds, Access, Zenith, and UBA, they are net long on foreign currencies, which means they have more foreign currency assets than liabilities, which means that when you have a devaluation, as we are projecting for the year, they stand to benefit more. So we think they would not have any problem servicing their obligations. And for the short duration bonds, Access 2021, Zenith 2022, and UBA 2022, we are bullish on them. For Seplat, we're a bit neutral because we cannot yet call the bottom of the oil market, which can affect sentiments on the bond in the near term. So I will now hand over to Taj to provide us an outlook for the equities market.
Okay, so thank you very much, Amotola. And then we quickly go to the outlook on the stock market. At the beginning of the year, we were looking for a base case return of plus 11.2%. But as we speak, because of the latest development, we have reduced our base case return expectation to 5.7%. We note that our previous bear case return of minus 16.1% has materialized, and that is indicated in the about 16% decline in year-to-date. On a year-to-date basis, the all-share index has declined by about 16%. And but on the bull case, we are looking at 20.9%. So there are key factors we believe we should bear in mind in this regard. Number one is global growth outlook. We have talked about stimulus and plans being put in place by monetary and fiscal authorities around the globe. If all those sort of measures, begin to support economic recovery, and then lockdowns are lifted, mostly speaking, in the third quarter, we should begin to see, a bit of recovery on economic activities. The devaluation of the currency is one major thing that we believe is also good for us to bear in mind. We believe there is still more for the CBN to do in terms of, currency adjustments to reflect the true pricing of the naira. By the time we have the true pricing of the naira, we think that foreign investors will be, positive on the market, bearing in mind that the market is already, reflecting the true price of the currency. Crude oil price outlook, we have given it earlier. We believe that a recovery, is on the cards in H2, assuming all those factors that we talked about earlier, materialize. We think foreign investors, probably, be conscious of the stock market. Nonetheless, it is likely that, some that are still sort of trapped in this market in terms of their inability to completely get out of the market may be willing, to just roll over, their investments. If we go quickly to how COVID-19 is likely to impact, sectors of the economy, the banking sector to start with, we believe that, investors should focus on banks that have long foreign currency positions, and also banks that are well diversified, in their loan book exposure, and also, banks that have strong digital networks. So if you take a look at it, you find that physical transactions in banks have been sort of, halted, but there are still transactions going on digitally. So we favor banks that have strong digital platforms in this regard. We bear in mind also that there could be weaker asset quality and, some sort of and result in impairment. But our sense also is that for banks that have strong risk management framework, the impact of a possible exposure to the oil and gas sectors and probably foreign currency loans should be somewhat minimal if they implement a strong risk management framework. In the insurance sector, our sense is that the recapitalization exercise is going to slow down, but chances are that we will hear or see strategic investment in the sector where we have, for instance, today we heard about a major banking group looking to divest their investment in their insurance business. And we, of course, an investor will pick that up. So we believe such strategic sort of investment, will likely be announced in the next couple of quarters. On the consumer sector, we see that sector as a sector where, largely speaking, the winners there will be the food producers. This current period, even though we are in a lockdown, food producers are still allowed or exempted, and so they are still doing their businesses. So we are positive, for businesses that are producing food, and we believe investors should watch that space. Nonetheless, the downside risk to that sector is, naira devaluation, which could drag the earnings of companies that have material exposure to raw material import, as well as foreign currency loans. But we believe for some of them that would be able to restructure their balance sheets, the risk will be minimal. The agri sector, we believe, is positive in this regard. If you bear in mind that they are able to export commodities, so if they are able to, for those that export, naira devaluation is positive for them, and we think the CBN's sort of support in terms of financing is positive by lending at materially lower interest rates, just to minimize the effect of COVID-19 on this sector. The cement sector, our sense is that volumes most likely will contract in 2020, but we think the price war in the industry will probably, be reduced in the sense that, we believe some of them will look to protect their profit margins, in the sense, given the COVID-19, outbreak, and also the expectation of lower volumes. Chances are that we will see in Q3 or in Q4 cement producers, increasing prices just so that they protect their profit margins. The oil and gas sector, we've talked about it earlier on, and we believe there will be some sort of decline in production and new drilling activities. But what we expect are two broad expectations. Number one, for the oil and gas sort of players, is for them to cut back on their capex expenditure, and that will, limit the impact of the current challenging environment on their cash flows. And then we expect them to also be more efficient in their operations to protect their profit margins. The telecom sector looks like the major winner alongside food producers. As I said earlier, the telecom sector, we believe, will be driven by data demand. Despite the fact that we are in a lockdown period, companies and businesses are still operating, they are telecommuting, so which means data demand has been rising, and our discussion with key players in the industry, points to strong data demand. And if you consider also what's happening to voice is broadly stable; it is not falling. So one would expect a positive sort of outlook for the telecom sector in the next half of 2020. If we go to the entire market, what you find is 20,000 points is one point that the market has been able to defend, even as at the last, global financial crisis, and that point is still being like a major support level for the market. And we do not see, unless if coronavirus sort of cases worsen materially globally, and also probably in Nigeria, or maybe oil prices, go completely out of control. Maybe that is when this 20,000 level will be breached. But as we speak, we think that level, still looks like a good support level for the market. Finally speaking, our recommendations and the stocks we believe investors should be focused on in buying, as indicated on the slide. And we like these tier one banks, Access, Zenith, and Guarantee Trust Bank. We believe those are the strong tier one banks investors should be focused on now. And we like Stanbic IBTC. We particularly like the wealth management business of that group. We like some two bureaus in our space. We like Nestle. Danksem and Lafarge are two stocks we believe that investors should also be focused on. In the telecom space, we are positive on MTN. And that's it for us, and we will appreciate questions as I pass it to Larry.
Taj team, thank you very much. Quite very detailed and very informative. Again, to our audience, thank you for joining us, and we'll definitely share the slides at the end of the presentation to everyone, as long as we have your contact information. So there's some questions in the poll, and I'll probably start from the last question I have here around the rally we're seeing in the NSE. The question is it attributed to trapped FPIs?
So that rally that we are seeing on the NSE is partly the trapped FPIs, but it is in most part some positive news coming from crude oil prices, the agreement by the OPEC Plus, to cut output. That suggests that if you are riding that macro, investors will be running ahead of the agreed cut by the OPEC Plus. So, and at the same time, prices came to ridiculously low levels at some point. Very good stocks were trading at 3-year low, 5-year low. Investors saw those and then they took positions.
Okay. And I'll probably have one of our colleagues, Akeem Shadari, who's the managing director of our stock brokerage business, to probably chime in. He sees the market on a daily basis, and he'll probably, be able to add additional color. He's currently trading, but we'll try and see how we can drag him into the conversation. Another question is around, based on our organic reserves, what is the estimate? Where do we see the currency should be? Where should the Naira dollar be trading, considering where and again, it's organic reserves, not what the CBN is publishing to us?
Okay, I will take that question, Larry. So, we have provided the outlook, and our view is that to actually, so the key problem for the CBN is that we are facing challenges both on the current account leg because of falling oil prices, and the capital and financial accounts because foreign portfolio investors are trying to leave the country. And our view is that for the CBN to be able to actually contain that pressure and rebalance the current account to sustainable level, where the exchange rate should be by year end, should be between 450 and 475 naira to the dollar. So we are still retaining that expectation.
Okay. All right, great. Thank you. Another question is around, as a firm, we're big advocates of local finance and of infrastructure. A question is, what's the implication of still trying to source dollar funding? And I believe they're speaking to, the IMF and World Bank funding that's available.
Okay, so for the IMF and World Bank funding, we think it's good to dimension the funding into two things. So the first thing is that not all that funding will be for the federal government, because a portion, particularly the World Bank loan, which is about $2.5 billion, a portion of this will go to the state government, about $1 billion, and the other, which is $1.5 billion, will probably be a project-type loans, perhaps spoken for already by the power sector. And then the amounts we actually need to finance the budget for the year, which we have made provision for, is 850 billion naira, which is essentially about $2.5 billion. And we think a substantial portion of that will be coming from the IMF facility that the country is currently requesting for. But I think the key thing to note also is that this is not a sustainable way to actually fund your fiscal deficits, because we have seen Nigeria recording fiscal slippages consistently over the past 34 years. Last year, for instance, our budgeted deficit was about 2 trillion naira. We ended up doing about 4.5 trillion naira of fiscal deficit, which was even higher than the revenue for the year. This year, the same thing will happen with deficit being higher than revenue. So we think post-COVID, right? Naturally, this time is not the best period for fiscal consolidation because of the emergency nature of the health pandemic. But post-COVID, one of the key things that the IMF will be discussing with the federal government before actually granting that request would be how do you sustainably rebalance your fiscal accounts such that you don't have recurrent fiscal slippages, such that your debt servicing costs do not begin to take a very huge portion of your revenue. And we think that will result in some significant fiscal reforms. And we're already seeing signs of this. I mean, federal government has committed to actually deregulating, the downstream oil and gas sector to an extent, with the move by the Petroleum Ministry and PPPRA to be announcing the markets, prices of PMS on a monthly basis. We think that's a very good sign, but more hard decisions have to be made post-COVID.
Great. Another question from the audience is also, we did not reference pharmaceuticals and Julius Berger as our top picks, given the environment we're in.
Also, the names that we have displayed are a reflection of the sectors that we cover. So for now, we do not cover pharmaceutical stocks. Largely speaking, those stocks are penny stocks. So, the question now is, can we or will we at some point consider, the coverage? The answer is yes. We always look to expand our coverage, but as we speak, we know the current development is positive for the sector, but we wouldn't be talking about, stocks that we do not cover. The ethics is that we talk and give forecasts on stocks that we cover. So chances are that in the future we consider covering the pharmaceutical sector.
All right, thanks. I think it's quite obvious, right? So even in the healthcare sector, particularly the drug manufacturers, in the event of a solution or a cure or a vaccine, it's definitely, if any of the players in Nigeria are positioned to sell those in Nigeria, I think it's obvious that they will be beneficiaries of the current environment. A question around, what do we estimate to be the holding of FPI in the NSC? And this post sell down, I guess they want to understand what's left who's in the market, what's the breakdown between foreign and local investors in the current market today?
I will speak partly to this, and I'm not sure whether Akim would have to chip in sometime. But based on the external position data that we had for Q4 19, FPI has had about $4.2 billion in the equities market, and we know that historically, in 2016, before the markets bottomed out, the holding of FPIs fell to as low as around $1.6 billion. And we know we have seen quite a bit of sell-offs in the beginning of the year, particularly in March. So that $4.2 billion would be, very, very, much more lower. We can't give you a specific figure for now, but I think our base case view is that we're probably seeing, more than $1 billion of outflows from equities. But I will allow Akim to have.
Yeah, I think Akim is on. Akim, it would be great to get your views since you see the market daily.
Okay. So basically, what we're seeing in the market at the moment, we're seeing more of participation from the local investors. Most of the foreign investors, they are very, very thin in the market at the moment. Both in the equity space and also in the fixed income space. The real problem is getting money out of Nigeria. So normally, on average, it takes within 48 to maximum 72 hours to get repatriation done in Nigeria. But as we speak now, it is estimated about $700 million is still outstanding. So, and it's some of them, they've been on the queue for more than 3 weeks. So in terms of what they still hold in the Nigerian equity space, you can't really put a figure to it, but I'll say in terms of proportion at the moment, it is actually less than 10% of the total market. So we are seeing more locals, local participation, and in terms of holding in the market, we are seeing more locals. I'll put locals very close to 90% as we speak.
Thank you very much, Hakeem. Another question here is around, if we're thinking the construction industry will contract, why are we picking Lafarge and Dangote as a buy?
So the pick of Danksem and Lafarge as a buy, for Danksem to start with, it is a reflection of their strong footprint, and secondly, it is a reflection of when activities reopen completely in Nigeria. You would see much volumes going through for them. So the period where we have this lockdown, that's the period that we expect, that will impact their volumes, not when, activities have been fully opened, for everybody to go out and embark on their businesses. So by the time we have, the lockdown is going to is going to benefit materially on the back of that. That's one. Two is around the fact that Danksem is not only in Nigeria, the footprint is across key countries in Africa, and one would expect some sort of support coming from that region as well for them. On Lafarge Africa, there is one key story about Lafarge, which is about balance sheet restructuring. That company has been able to take foreign currency debt out of its portfolios, and one would expect that 2020 is 1 year where you would see, if you take out the impact of COVID-19, which is this lockdown of about a month, you should see stronger earnings from Lafarge as they have restructured their balance sheet and also divested from the South African business, which was prior to now margin dilutive. So the Nigerian business on a standalone basis is a strong business. That is why we put Lafarge and Danksem on a buy list.
Okay. What's our outlook on fixed income and FX post-COVID? I know Omotola talked on it, but it'd be nice to just rehash this for our audience, please.
Thank you, Larry. So as I explained earlier, so the key reason why the Nigerian bond market has been outperforming its local currency market, particularly, has been outperforming its EM and frontier peers, which have sold down heavily these days because of liquidity. Demand far outweighs supply, but supply is set to pick up. We are not sure by how much because we haven't gotten a definitive feedback from the DMO on the plans for the issuances for the rest of the year. But what we know is that there's a 2.8 trillion naira financing hole that has to be plugged, but we are not certain yet if that deficit will be monetized by the CBN or it will be raised from the market. So that's why I said we need to get a definitive feedback on this before we proceed to give a definitive outlook. So which is why we are recommending that for those in local currency markets, the best thing to do at the moment is just not to take too much of an active bet and keep your portfolio duration very close to market duration so that you can benefit from however the market swings. And the second thing to also take into consideration is that the CBN is planning to launch a 15 trillion naira infrastructure financing fund later this year, and they'll be looking to start off with about 1.5 trillion naira. And the plan is that a portion of that fund will be raised from the local fund managers, particularly the PFAs. So with the budget financing deficits, as well as the central bank's own initiative to fund infra, there's a potential that supply will materially pick up. But what we also have to take into consideration is that the CBN, they've not made any rate cuts so far this year. They still have the CRR harmonization, which they can unleash anytime they want. We saw it happen in Ghana. So in Ghana, at the beginning of this COVID thing, we saw a sell-off in the bond market. But after the central bank stepped up, and he ignored the threats to external accounts and began easy monetary policy by cutting interest rates, by over 150 basis points and lowering cash reserve requirements as well. We saw a pickup. Despite the fact that offshore investors were selling. So that's why I'm saying that until we get the specific budget financing plan, the direction of the CBN's monetary policy, the best thing to do at the moment is just wait out the storm and keep your portfolio duration very close to market duration.
Okay, thank you. Here's a set of questions from one of our, from the audience here is, what is your suggested play on the Nigerian fixed income over the rest of fixed income market over the rest of 2020? Beyond 2020, what are our views on interest rates when the PFA related liquidity blows over and the last OMO maturity is done? And finally, what are the chances of a CRR cut in 2020?
Right. Thank you, Larry. So the first question is talking about the fact that by October, all the non-bank local investors would have fully switched out of OMO securities, right? We also have to understand that beyond OMO maturity, there's a persistent liquidity supplier in the Nigerian fixed income market, and that is the monthly FAC distribution, right? So whether you have OMO or no OMO, as long as you're having FAC distribution, then you have a liquidity event every month. And we have seen that recently, the OMO mop-up by the CBN has been very, very minimal, because they have discouraged commercial banks from actually buying OMO bills because they are actively trying to wind down their OMO position, partly because of the impact it is having on their balance sheet. So with the CBN not interested in really taking up, more HOMO obligations, except when necessary and when they are sure that the FAs are the ones buying it, right? The outlook for liquidity is a bit nuanced. So it all depends on what the CBN eventually does regarding the CRR, as well as when the FPIs will potentially return to the market, which again, goes back to, our initial recommendation that now is not the time to take, very strong active bets. Now is the time to, stay very neutral and watch what happens regarding, hopefully in the next 1 or 2 weeks, you see the Minister of Finance actually submitting the revised budget to the National Assembly, and then we can gain more clarity on the budget financing plan. And on CRR, like I said, there's a very good chance it might happen if we see the federal government, looking to borrow actively in the fixed income market. CBN could, jolly well, make a CRR cut to support the financing plans of the government. That will be all from me, Larry.
All right, thank you very much. There's questions around our top 10 picks, and people are curious to know, why is international based on our top 10 pick?
Okay, so what we have always communicated is that international borrowers is a long-term play. For our clients that received our initiation of coverage report, which is a very detailed report, we indicated in there that go long. So if you are investing in international borrowers, it is a long-term investment horizon that we're looking at there. Our view is that, so there's a major development that happened a couple of months ago, which is the restructuring of the balance sheet where they did the right issue to take out debt. So we believe that is going to play out positively for them, and we also see them being supported by their brands, which are largely speaking brands that average Nigerians are down trading to, given some sort of pressure on the consumers' pocket. So that stock has performed, somewhat, badly, largely because of, results that were coming out. But the right issue, has been concluded, and then post the right issue, we expect the numbers to look a lot better. And, so from there, investors will begin to appreciate the numbers of international borrowers.
Great. So I think it's more in context around, and I think the story around the restructuring it makes sense. But in an environment where there's a lockdown, and an environment where beer consumption is not a priority or it's not essential compared to food, how does our outlook, or what's our view, considering the lockdown, considering that people probably won't be, focused on drinking beer in the near future?
So we are still saying the same thing because we aren't looking at the current, sort of development. If you want to look at lockdown, you should not be buying any brewing stock. But we aren't looking at the current lockdown. We are looking beyond the current lockdown for international breweries, for instance, and post, the lift of lockdown, they will be fully back, into distribution, and then bars will reopen again, and ceremonies or celebrations, we kick in again. So it is, if you have a short-term view, I think as an investor, you wouldn't be looking at any brewers, not even Nigerian brewers. But if you are taking a medium to long-term view of those stocks, and there you look at where the prices are now, you would like to position, against, you would like to position ahead of any major recovery in that space. That's the way we think investors should take a look at it.
Okay, I think that's a good segue to this next question, because someone is looking to see, how can I make a quick turnaround in this environment in the stock market? What can I buy, and and I will get a decent return in the short term?
Okay, so if it is what to buy and you want to make some decent return in the short term, my strong view is that you take a look at the banking sector, because that is where you would get, number one, cheap valuations. And number two, that is where you would get liquidity. Liquidity in the sense of, of when you want to go in, and liquidity in the sense of when you want to, get out of the stock. So I would recommend that, you take a closer look at GT Bank and also, Zenith. And Aderonke can speak more to those two stocks. But I believe that, the banking sector presents that kind of opportunity for investors.
And Ronke, right before you start, let me throw in this question because it's down your alley, right? So the question here is, what is your view on Access Bank relative to FBN? So I think you can answer that, and also the alley hoop that Taj gave you can also follow up on that too, please.
Okay, great. Starting off from what Taj just said. So essentially, for us within the banking sector, our top picks are Access, GTB, and Zenith Bank. And the way that we'd like to look at our preference within the banking sector would be from about 4 to 5 different factors. The first one being that we would have more preference for banks that have long net foreign currency positions. And this is where GT Bank and Zenith are leading compared to the other banks within the sector. The second one being in terms of the strength of their digital channels. And this is also where the tier 1 banks are leading. And to speak on this in relation or comparing Access to FBN, this is where Access has the upper hand compared to First Bank. And Access's upper hand was also enhanced by the recent merger that they did with Diamond Bank. So in terms of spread or distribution of their digital network at the moment, Access, we believe, would largely benefit from the current environment where investors or consumers are having to use more of electronic banking channels. The third factor that I think we should put into consideration is in terms of diversification of the loan book across different sectors, and also in terms of the currency focus of the loan book. So our preference would be for banks that have their loans that are largely denominated in local currency. Again, this is where GT Bank and Zenith are leading. And again, this is where Access has the upper hand compared to First Bank. The fourth factor would be in terms of the risk management framework that banks currently operate with. Access Bank traditionally has had a really strong risk management framework, and we can see that reflects on how they have improved asset quality since they merged with Diamond Bank. So this, we believe, gives Access Bank a upper hand compared to First Bank. And then the last factor would be in terms of the balance sheet size and also in terms of the capital buffers that we think the banks have to be able to withstand the current risk and headwinds that we're seeing in the macroeconomic environment. Again, this is where we think that top banks like Zenith, GT, and Access are leading compared to the others. And the way we like to look at this is in terms of the headroom that the bank's capital adequacy ratio have over the regulatory minimum. So for banks like GTB and Zenith, they are well ahead of the regulatory minimum with over 20% capital adequacy ratio. For Access Bank, it's around 20%. However, for First Bank, is a big bank, but in terms of their CAR, they are close to the regulatory minimum with CAR of 15.5% compared to 15% regulatory CAR. So these are the key factors that we think investors should look at if you want to position within the banking sector this year. And as I've mentioned, these are the key factors that we believe puts Access Bank at a upper hand compared to First Bank.
Thank you. It's a question around the telco sector, and Airtel was not considered. I think this speaks to what you mentioned earlier, Taj, around we've not initiated coverage on Airtel, so we won't be able to make a recommendation on that name. But I think, the trends we're seeing in the sector, particularly with MTN, I'm sure Airtel will be a beneficiary also. A question around the CBN announcement around a 15 trillion naira fund. So PFAs are currently, about 70% of their portfolios are in FGN securities. How does the CBN intend to raise this fund?
So thank you, Larry. I've answered that question. So at the moment, I think if you juxtapose what the CBN governor said in that speech with what he initially announced when COVID-19, first hit Nigeria about their stimulus plan. So initially, what's the information he gave to the market was that there'll be a 1.5 trillion naira infrastructure fund. But in the new speech, he said it is about 15 trillion naira. But in our own view, it is very, we don't think it is very feasible to raise 15 trillion naira in this market at the moment. Because the entire banking assets is probably around 40 trillion naira or thereabouts. So it's if you compare PFA assets as well, the current amounts they are targeting is even more than it. So we think what will likely happen is that they actually want to start off with 1.5 trillion naira, but they will scale up to 15 trillion naira in the future. So regarding how they intend to raise 1.5 trillion naira, they could be as very creative as possible. I think one thing we have to acknowledge about the current CBN administration is that they're very, very creative in terms of their policies, and they're very, very unconventional in nature. So one thing they can look at is to allow both PFAs and commercial banks to invest in it. Number one, if you look at the commercial banks at the moment, they have their mandatory reserve with the central bank, both in terms of CRR debits and LDR debits, at above 7 trillion naira, being held with the Central Bank of Nigeria. So CBN could as well say, okay, if you intend to direct your mandatory reserves, with us to invest in this infrastructure fund, we will permit you to do that. So there are lots of creative ways they can go around it, but we think all that amount will not be financed by the CBN alone, and they'll be looking to partner, with commercial banks and the PFAs. And we'll wait to get more information on that. And when we have this, we're going to update the markets.
Thank you. Question here around, do we foresee a phase lifting of restrictions or a complete, total lift on the restriction, and what kind of impact do we see on the economy?
We gave an indication of that in our GDP, growth outlook. So our expectation is that we should begin to see a phased, we call this staggered exit, probably around May. As Ronke mentioned, it takes about 5 weeks for COVID-19 to peak in all the other countries that we have monitored. We are only about 3 weeks into the lockdown, so we have about 2 more weeks to go before we begin to probably, if we ramp up testing and things go right, for Nigeria, we may begin to see, the curve, flatten by, let's say, around May. So perhaps to begin to see a phased, exit from the lockdown, by May. So the states that say have, very high, high level of new cases perhaps will be extended, but the states, that have very little cases, for instance, and they are seeing, decline in the number of, new cases, they might have to be exempted. And the impacts on the economy. So as we mentioned, our outlook is that we're going to see a contraction. The IMF is the most pessimistic in the market today. The outlook is a minus 3.5% contraction. We're relatively a bit more optimistic at minus 0.1, but as we said initially, this could change as well. And that's partly because we still expect Nigeria to record a growth in Q1 and also a growth in Q4, however minimal. And then we have some sectors that are recording above trend level of growth in double digits that can provide some support for the overall economy.
Great. It's a question here on FBN's approach, what's our view for them exiting from the insurance business, and also their grand plans of entering into Africa?
Okay, I'll take this question. Thank you. So for us, we think that essentially what FBN Holdings is trying to do is to more or less focus on the core banking operation by divesting from the insurance business right now. And also, I mentioned earlier that they have CAR for 15.5% for FBN Bank itself, and that is really close to the regulatory limits. So as much as possible, I think the focus now should be directing all of their capital towards their banking operations, and just letting go of any other operations that would require capital from them. And for their expansion into African countries, I think this is good in terms of diversifying their income sources. So in a situation where we have some countries not performing well because of macro conditions, then performance from other countries should be able to make up for that. But in this current environment where we have a global event, I'm not sure how that would have so much of an impact. And I'm going to take this and move on to the next question as regarding why we prefer access over UBA. So I just mentioned how when we have a global global events affecting all countries, UBA has operations outside of Nigeria that are pretty much very strong. So a macro event like this would have an impact on all of their operating countries. However, Access Bank at the moment is largely focused on Nigeria. So that is the reason why at the moment we prefer Access over UBA. But having said that, we have a buy rating on UBA as well. So it's not like we are not buying UBA. We are buying UBA as well, but we prefer Access Bank to UBA at the moment.
Okay. There is a series of questions around access and why access, and I think you've pretty much covered that. I think one of the key concerns here is around dollar liquidity, and for manufacturers that have to import raw materials, or for corporates that have some kind of dollar on their balance sheet, and how do they service those loans, and some multinationals that have to upstream dividends to the parent company. What's our view on liquidity? I mean, we're hearing their cues, and how do we see the CBN or the government, solving this issue?
So on the issue of queues in the fixed income market, so what we know for a fact is that CBN has stopped selling. If you track high and key window data around late March, and since then we have seen over 800 billion naira of almost mature. So typically FPIs hold about 40% of almost. So that would imply that we are probably seeing about 300 to 400 billion naira of FPI money, which have not been rolled over, waiting to leave the country. And then we also have some other, exits from the equity market, as well as the bond market. So, on average, perhaps we could have the queue getting as close to $1 billion, if not more. On what will happen after the lockdown, so as you said initially, CBN cannot sustain the current pace of intervention that they had before they stopped selling. Last year, they sold $38 billion, in terms of intervention. If they want to keep up with that, they will run out of reserves very, very soon. So what will likely happen is we're going to see a lot of capital controls wherever possible, and some restrictions, on offshore transfer of funds. Already they have begun to actually introduce this. most of the commercial banks in the country today, they must have sent you a notification telling you that you cannot exceed a particular limit, on your debit cards when you are buying foreign currency denominated things. And then even from a regulatory perspective as well, CBN has also made it more difficult for you to actually move cash deposits in your DOM account around the country. So we expect to see, a lot more, capital flow restrictions probably setting in to allow the CBN at least give them a breather to allocate the various cash effects that they have, for you to go around in terms of financing the very essential healthcare and food requirements of the country, and then before it then gets to financing the unregulated activities in the BDC segment. So most likely the BDC segment will be the ones to suffer the most. In 2016, what the CBN did was that they suspended selling of FX to BDCs for about 11 months, and they only resumed when liquidity began to improve in the FX market. So this temporary suspension of sales to the BDC may turn into a much more longer one, perhaps so. Right now, it has gone on for about a month. They could probably even push this further down the road so that they can cater to the much more important things to them in the hierarchy of needs.
Great, thank you. So I'll just take one. This is the last question we're going to take, so we can have people head back to their daily lives. On the infrastructure fund, bank balance sheets are funded by deposits with short-term duration. What would the implication of pushing bank monies into CRR, into long-term infra funds? There's a concern around the mismatch. You definitely have some implications. So what are our thoughts on that?
So our view is that we are actually having unconventional monetary policy in Nigeria. So you could argue that it's positive economics and normative economics. So that is what things should be and what they actually are. And I would say it's more of the latter that we are having at the moment. But one key way they can solve this maturity mismatch is probably to securitize the fund as well, such that, for instance, the mortgage loans in the US, for instance, they're securitized, so you can actually trade them. So CBN could probably, after the initial startup of the fund, they could securitize it and make it more available for the public to invest in Nigeria's infrastructure. So that could be a solution. We are not sure yet. We're just speculating for now on how they can raise this fund. But if this is the way they go to solve that maturity mismatch, I think the right thing to do will be to securitize, the assets and make it tradable.
Great. Thank you. And listen, on this infrastructure, it was a letter the CBN governor published a few days ago, and details are still scarce. And I'm sure as we get more information, we'll definitely share with the market and with everyone. But it's definitely an interesting development that we are watching very, very closely, and it's something that we believe the country needs, and will be very accretive to what we do as a nation. So once again, thank you everyone for attending, for taking the time out. We will share this deck. It will be very helpful if you can send me an email, and I can definitely push this out to you, because there's been a lot of requests for the presentation in the Q&A session. So Taj, Omotola, Ronke, everyone at Chapel Hill, thank you very much. And we will be in touch. The team publishes very regularly. I think we pushed out almost on a daily basis notes, because this whole COVID thing is very dynamic, very fluid. It changes on a daily basis. The government has been very, very active, with palliatives and policies, and we'll continue to provide that information to you as they come to us. So thank you. Please stay safe. Follow the COVID protocols, wash your hands, social distancing, and we will, overcome. So thank you very much. Bye.